Okay, we are started now. So
good morning, everyone, and happy International Women's Day. And it is our pleasure to bring you the 5th annual International Women in Trading and Investing event. Thank you so much, everyone, for being here. This event is brought to you by Timing Research and TradeOutLoud, and the entire event is being recorded separately with each presenter. All the recordings will be available as soon as David is processing, and they will be available on the Timing Research website, the Timing Research YouTube channel, and all available podcasts. David Kosmeter and I, Anka Metcalf, are going to be your hosts today. We have a plethora of traders today that will be talking about futures, Forex, stocks, options, cryptos, and any other assets. So before we begin, let me remind you that all information provided today is for educational purpose only. It should not be construed as investment advice regarding the purchase or sale of securities, options, futures, Forex, or any instrument of any kind. Trading involves a high level of risk and may not be suitable for all investors because you could lose money. So before deciding to trade, you should carefully consider your objectives, your level of experience and risk appetite. Individual performance depends upon each person's skills, time commitment, and definitely effort. Results may not be typical and individual results will vary. You must do your own research and make your own trading decisions. So with us today, we have a fantastic lineup of pro women traders that are really happy to share their strategies, their tips, their tricks with you. So I'm going to give the mic to Alaina Nicole, and she's from Options Bay. Hey, Alaina, thank you so much for accepting our invitation. We're really happy to have you here with us today. Happy International Women's Day, and hit it. You have the mic.
All right, thank you so much. And thank you all for having me. Happy International Women's Day. I'm super passionate about helping women in the space. When I first started trading, I noticed it was very male dominated. So it's really cool to kind of like have a space for women to kind of come together. Excuse me. So my name's Alaina. I co-founded Options Bay and Investing Bay. And we do have men involved as well, but we just really love to help people learn how to navigate this market. So today I really wanted to do, we have like a full intro course, but I thought it would be cool to kind of go through that first chapter. There's a lot of information when you're getting into the market. And so I think it's cool, even if you've already been in the market, to kind of have this refresher. If you're brand new, this will lay the foundation for you and help you build upon that. So she did just do a risk disclosure, so I won't do it again. Just remember, trading and investing, they do carry risk. So you always want to invest responsibly. You don't want to have money in the market that you're going to need immediately. I would say 5 years or more. So this is going to be disposable income, but we'll talk about like asset allocation and things like that as we go. And feel free along the presentation, if you have questions or need clarity on anything, I'm happy to go over it for you. All right, so when you first get into the market, the first thing you're going to need is a brokerage. The brokerages, they facilitate your trading. There's a lot of different platforms. I have listed a couple on here. A lot of people, when they first get into the market, jump onto Robinhood. It is good for beginners. It's user-friendly, but Robinhood is very limited. It's very limited. So as you grow your account and you want to be like a serious investor, you do want to maybe migrate to a better platform. I like Thinkorswim. I call it like the granddaddy, but this is really where everyone pretty much ends up as they build. They have awesome customer service. They have a really, really nice platform with so many bells and whistles that can help you. They have a number you can call, like Robinhood didn't have that for a while. But if you have questions, you can call them and get help. Webull is also pretty cool. They have a good customer service line. They have, if you like investing, you can actually do extended hour investing on there. So you can jump in at 4 a.m., you can trade until 8 p.m. So that's really cool. Some others I listed, E-Trade, Fidelity, and Charles Schwab. One thing about Charles Schwab that I really like is you can link other brokerages. So if you have multiple, which I actually recommend you having more than one, you can actually monitor them all from your Charles Schwab. So I thought that was pretty cool that they had that. Another thing that I want to add to just quickly is the tax benefits. So a lot of these other brokerages offer like Roth IRA, and you can actually trade, and you can withdraw that money after a period of time without having to pay taxes. Like Robinhood doesn't offer any type of tax benefit. You're basically paying full on capital gains if you're trading, buying and selling anything within the year. So there's really no benefit to that. So yeah, we always want to think long term. All right, so these are the very, very basics. The stock market is just a collection of buyers and sellers of stocks, which represent ownership claims on a business. They include securities listed on a public stock exchange, such as the New York Stock Exchange. A stock, that's just a portion of the company that you can buy and sell. A ticker symbol, again, that's just a little abbreviation. As you get more acquainted with the market, those ticker symbols will come to mind really quickly. And then the IPO, that's your initial public offering. That's the first time a company's shares are listed on the market. All right, so you got 3 indexes. These are our major indexes, the S&P 500, Standard & Poor's. This is 500 of the top companies in the US. This includes stocks like Apple, Microsoft, Tesla, Amazon, Google, J&J, Berkshire B. The cool thing about the S&P and really all of these is the stocks are weighted. And we'll talk about that a little more later on. But each company that's listed is not actually weighted equally. So some of them have a lot more pull in there than others. You have the Nasdaq Composite. This is going to be for my tech people. The Nasdaq is actually composited. It's heavily made up of tech stocks. So you have your Amazon, AMD, Apple. Apple is actually in all 3 of them. Microsoft is too. You have DocuSign, EA, Facebook, Moderna, Microsoft, PayPal, and Zoom. If you guys noticed, after Facebook's earnings, it dragged the Nasdaq way down. It drug it way down, as well as the S&P. And so that was pretty interesting to see how one stock can affect the overall indexes. And then you have the Dow Jones Industrial Average. This is 30 of the most influential companies. This is typically when you think of the stock market, especially when you're starting out, these are going to be the companies that come to mind, like your Apple, your Boeing, Home Depot, McDonald's, JP Morgan, Coca-Cola. These are like the big boys, right? So the Dow is a really good way to kind of gauge the economy. But again, all of the indexes are super important to keep track of. All right, so the market is divided by indexes and it's also divided up by sectors. So when you build your portfolio, you really want to diversify with stocks from different sectors. A well-balanced portfolio is a risk management strategy. So real life example, if your portfolio, for example, is heavy in technology, right now you're probably down a bit because technology has been getting absolutely beaten down. Other industries right now, like your energy has been on fire. Oil stocks are on fire, your commodities are on fire. So one thing to kind of keep track of is the sector rotation. Throughout different periods of the economic cycle, their seasonality, different sectors will perform differently. So when we're in like a growth phase of the economy, you'll see like your consumer discretionary sector kind of, money kind of flows there. So when you think of consumer discretionary, think about things that people want, but not necessarily need. So think about things like your MacBooks, your home improvement, things like that. Your consumer staples, on the other hand, that's things people need. So when the economy is on a downturn, you'll start to see those stocks kind of pick up. And those are things that people need, like food and water and things that they're always going to have. But again, balancing that portfolio, that protects you from the downturns, right? It protects you from that sector rotation. So you always have exposure to a sector that's performing well, even if others are not. Exchange traded funds. These are going to be, I think you can think of these as like a basket. These funds are managed, they're actively managed. They're really good for beginners because they have a low cost and high liquidity. There's an example, Jets. Jets is an airline ETF. It's made up of different airline stocks, and it allows you to get exposure to that industry without owning. You don't have to own like Boeing, Spirit, Delta. You don't have to own every single stock. Jets is actually composed of that, and you get exposure. So what you want to do with these is like research them, understand what they're holding. And it's cool because they are actively managed. So the stocks that are not performing well, they oftentimes get swapped out for stocks that are better performing in that industry. One thing about ETFs, you're not going to get the full volatility. It kind of shields you from some of the volatility, not all of it. But like if you look at the ARK ETFs right now, a lot of those have been kind of taking a beating with the market, but it's still cool if you like what they're holding and you believe in those stocks. You know, they will recover as the stocks they're holding recover. But an example for me, I was holding EEM. This is an emerging markets ETF composed of Chinese stocks. And when there was all the chatter about delisting the Chinese stocks, I actually had to cut this because it was getting beaten down. So I had to cut it. So that goes to say, like, just really make sure you understand what's being held in your ETF. But again, if it's got solid holdings, then it can be a really nice thing to have in your portfolio long term. All right, so dividends. Dividends are amounts of money that companies pay out to their shareholders. Some of them get paid out monthly, quarterly, or annually. You want to add like high dividend stocks to your portfolio long term and just add to them over time. And this is just the way to make passive income. There's so many stocks that have dividends. They, sometimes they'll increase dividends. We've seen companies take them away. So if you do have dividend stocks, just make sure you stay current with what's going on with it, because you don't want to hold something that's done away with their dividend. I think I had Geo. Geo was a stock that I was holding that got rid of their dividend. So it's just something to keep track of, but there's a ton of them. All right, so let's get into stock options, my personal favorite. So if y'all remember, buying a stock allows you to own a small percentage of that company. It's ownership. Stock options allow you to control 100 shares of that company for a set period of time. So these are control, the stocks are ownership. So there's a difference there. Stock options are bought and sold in the form of a contract, and then a contract represents 100 shares. So the cool thing about stock options is the leverage. I love the leverage. Stock options allow you to profit when a share price increases or decreases. And then once you get a little more advanced, you can actually profit as a share price moves sideways, but that's for another day. So you can leverage stock options to profit no matter what the market's doing. And there's two types of stock options. There's calls and there's puts. All right, and so this is just a little tip. In order to access options trading, a lot of platforms will ask you to apply through your brokerage. And this can be found in your settings. And again, some of those brokerages, you can actually call them and they'll walk you through it, which is a nice thing to have, so you can really understand. Options are extremely risky. So they want to gauge your risk tolerance and make sure you're not going to like devastate yourself financially to do this. So when they ask you those little questions, be truthful. If you don't get approved, they just want you to have more experience in the market before you get exposed to options, which is totally fine, because again, options do carry a lot of risk if you're super new, really, for anyone. Options are risky for anyone. All right, so the two types of stock options, we have calls and puts. Calls allow you to profit as the price of a share increases. You buy a call if you think the price is going up. Puts allow you to profit as the price of a share decreases. You buy a put if you think the price of the stock is going down. All right, so this is an old screenshot from Robinhood. Again, I don't like Robinhood as a full-on, this is my brokerage I'm building here. But as far as the layout, I do like how it is laid out. So like when you're learning, all these numbers are going to look the same. This is called an options chain, and we'll break down the parts, but it'll look different depending on what brokerage you're using. So again, this is Apple. And this is an old screenshot, but this large number here, this is called a strike price. So think of the strike price as a price target. In the sense of trading, I think of it as a price target. So your contract represents 100 underlying shares at that strike price. Also, when you buy a call, you do have the right to exercise. And what that means is you can buy 100 shares of the stock at the strike price. Exercising isn't something that's done super often, but in the event that you ever decide to exercise something, then you would be buying those shares at the strike price. So that being said, you can see this down here, these strike prices below your share price, these are referred to as in the money. And then the strike prices above the share price are referred to as out of the money. Okay, so let's talk about premium. All right, so look at this number in the box. This is called your premium. So stock options, again, allow you to control your stocks at a discounted rate. So we're talking about 100 shares. So this premium is going to allow you to purchase, this is your price per share. So this is your entry cost for this trade. So let's say you want to buy this 130 call, then it's 283 times 100 shares that we're controlling. So we'd pay $283 to control 100 shares of Apple at this strike price. Does that make sense? So I know it's a lot, but if you're brand new, I know it's a lot, but no worries. So your premiums, if you'll notice, again, this is in the money. So the deeper in the money that you go, you notice your premium gets higher, right? It gets a little more expensive. So here's your out of the money. And the further away from that strike price you go, the less you pay on your premium. And so there's benefits to both sides of these, which we'll get into. But for now, just know if you're ever confused, and I'll show you the put screen as well. If you're ever confused on what's in the money and what's out of the money, just know the deeper in the money you go, the higher that premium. All right, so contracts also have expiration dates. I like to call it a shot clock. You really want to get in there and get your profit and get out before it expires. Over time, contracts lose value. And we'll discuss that later, but the goal is to get in and out of your trade before they expire with a profit. On this expiration day, again, you can exercise your contract if you want. If you're in the money, you might still have, you will still have your premium, so you can sell it and take profit. If you're out of the money, chances are you're probably going to expire worthless. But my rule of thumb is half the time. I really like to exit in half the time. So if my contract expires in a month, I really want to get out within the first 2 weeks. And the reason being is time decay. And we'll talk about that. But again, just know the longer you hold this, you're paying a little bit of rent every day you hold this. So the quicker you get out, the better. And about halfway through, the time decay does start to kind of creep up on you a little quicker. All right, so the break even, this is going to be your premium. So this is your premium plus your strike price. This break even number, a lot of people kind of get hung up on it, but all it means is once you break even, once your share price hits that break even number, you've doubled your money. That's 100% profit. Now we can profit at 10%, 20%, 30%. Every trade is not going to be 100%. Every trade is not going to be 1,000%. Do we have unicorn situations? Absolutely. But that is not an everyday thing. And if you are someone who is interested in becoming a day trader, that should not be your everyday goal because that is not realistic. I like to set expectations. 20, 30% on a day trade is a good day. That is an absolutely fine day. Okay, so let's get into, does anyone have questions about any of this before we move on to the next slide? All right, so let's talk about puts. Puts are very similar. It's just the inverse. It's opposite. So puts, again, allow us to profit as the price goes down. And so again, you have a strike price, you have a premium. If you'll notice on the puts, the premiums, they're flipped, right? So over here, these are out of the money, right? Our strike price below the share price, these are our out of the money options on puts. If your strike price is above that share price, then we are actually in the money. And as we go higher, we're deeper in the money. Again, one difference between calls and puts is the max profit, right? So a stock can go up forever. There's no ceiling, so there's no max profit on a call. Now, a put, on the other hand, can only go down so far, right? Our stock can only drop so far before it's zeroed out or delisted or what have you. But the max profit on a put is going to be your break even times 100. So if you see a company go bankrupt, if you see a company have, really bad news, if there's a big sell-off, like that's, pretty timely, but there you can profit on the way down. So these are really cool to hedge. Like if you have a lot of shares of something, you can actually buy puts and like hedge and make money on the way down. And then your shares are still there. And then you can take that profit and just add it onto your shares. So it's really cool the leverage that you get from stock options. And again, these expire just like calls do. One other thing I want to mention quickly is so you can see up here, and again, this is Robinhood. Your other brokerages will be laid out a little differently. But if you're buying a call, you want the price to go up. If you're buying a put, you want the price to go down. Remember, in the market, there's only two things you can do, right? You can buy and you can sell. If you buy your way into something, you have to sell your way out. If you sell your way into something, you have to buy your way out. That's literally all we can do. So if we sell a call, we actually want the opposite to happen, right? So if I'm a seller, I'm writing the contracts, I'm selling premium. So I can sell a call, but if I sell the call, I actually want the price to come down. If I sell a put, I actually want the price to go up because I'm on the other side of that. So just remember, if you buy your way in, you sell your way out. If you sell your way in, you buy your way out. If we're buying a call, we're bullish. If we're selling a call, we're bearish. If we're selling a call, we're bearish. And if we're selling a put, it's actually bullish. So that's just something to remember if you ever want to be on the other side of that premium. All right, so these are your contract stats. You can look at these on your brokerage. You can pull up bar chart. You can pull up a lot of different resources to kind of find out about your contracts. But all of these things you want to know before you jump into a trade. You absolutely want to be aware of this. So the first thing I want to talk about is the bid and ask. The bid ask is basically, again, you have buyers and sellers, right? So the bid, those are your buyers. The ask, those are your sellers. So this 380, that's premium they're talking about, right? So the bidders, the buyers, 380, the sellers, they're asking 395. So when you go in to make a trade or go in to make an offer or enter your limit order or market order, you want to make sure that this bid and ask is relatively close together. You want to have a really nice spread. What happens is a lot of stocks don't get heavily traded, like a lot of options on certain stocks don't get heavily traded. There's no volume, no liquidity. So this spread might be, $5 apart. And if you see something like that, just remember, right? If you're the seller trying to get out, you're going to have to come down way down off that premium to get out of your trade, right? You want to make sure that these numbers are close together so you can easily enter and exit. If you're trading things with high volume, that's typically not an issue, but it's something to be aware of because it can affect your ability to get out of a trade. I saw it happen with the GameStop AMD situation. I had a $14 premium and the ask was like a penny. So I had to hold on to it until I could actually get out of there. And that was not a fun time. So your volume, this is just how many times this has been traded throughout the day. Open interest is basically going to tell you how many active open positions there are. So these are super important. Again, they go to show liquidity. Open interest is a really good indicator that you're making a good decision. If you open up the open interest and it's 0 or 5, think of it as a party, right? Think of it as a trader party. So if you're the only person at the party, you're probably not going to have a good time, right? So you want to make sure other people are there and they're holding that position too. I've seen open interest over 100,000. There's a whole lot of people holding something, and that's a good sign that you're doing something that a lot of people are doing. So that's one thing to always check. Other things you can see here, you'll see like the mark. And again, this is all pertaining to that premium, the mark or the mid. That's just halfway between the bid and ask. A lot of times when you're entering a trade, that's the first price you want to start off on. Sometimes I'll add, I'll go in towards the ask just to get my trade executed faster. And then when I'm getting out, I'll go in towards the bid just to get out faster. But that just goes to my personal trading style. Like I like to jump in and out really quickly anyway. Previous close, that tells you what this price closed at the day before. The high, that's just how high this premium went. And then there's your low for the day. So one thing to remember, and this is cool to look at too, but make sure you're not jumping in and buying something at the absolute high, right? You always want to wait until you get a nice price. And we'll talk about volatility as well, but you don't want to jump in at the high. You want to wait and kind of let this cook and see if you can get it at a better price for the reversal. All right, and then volatility. We'll talk about this more in a bit, but volatility, it reflects the anticipated move of a stock. One way that I think with our students that I've kind of explained volatility, think of it as a balloon. So like as the demand for a stock increases, like before an event, for example, like you have like earnings reports, you have investor days, you have product releases, anything that's going to make the volatility move, even like FDA approvals or like announcements, things like that, you'll see volatility kind of skyrocket. And so what happens is, again, back to the balloon analogy, volatility is going to pump up your premium like a balloon, right? So if you're already in there, then it's good for you because now you're making money off this rising volatility. If you're not in and you want to get in, right? Let's say you want to play earnings and you jump in, which I don't suggest that ever, but let's say you get in something that has earnings that week. That premium is probably going to already be inflated off volatility, so you're overpaying for it. So just like a balloon, it inflates, it also deflates. So after the demand is gone, after the thrill is gone, the event is over, you'll see volatility come back to life and it's going to crush the premium with it, right? It will crush that premium right down with it. It's called an IV crush. And so it's really important to be mindful. I trade the same stocks over and over, so I pretty much know where the volatility sits. Apple, for example, it's usually around 30%. Now you'll have times like during the election, during COVID, where volatility is high across the board, but you'll definitely see volatility get higher around those special events. All right, and let's do the Greeks while we're here. All right, so the Greeks are super important. The first one's Delta. Yeah, me too. I love Apple. So the first one's Delta. The best way to remember this, Delta dollar, right? Delta dollar. So Delta 0.56, this is going to tell me for every dollar, in this case, every dollar that Apple, the share price moves up, I'm going to make $56. And so what happens is as you go deeper in the money, the Delta gets higher, right? Your Delta can go up to like 0.99. As you go further out of the money, the Delta gets lower, right? So you can go out of the money and still be profitable, but you don't want to go too far out because there are other factors at play. So Delta is your dollar amount. This is going to get added onto your premium, and this is a fluid number, so it will move as the stock price moves. So theta, T for time. So theta, this is the rent we pay, right? This is our time decay. So again, this is $11 right now. So as of right now, if I'm holding this overnight, I'm paying $11 in premium. Now, this number goes up as you approach that expiration date, right? So as I hold it overnight, the theta is going to change, right? These are fluid numbers. So one thing to remember, again, the further out of the money you go, the higher that theta is going to go. The deeper in the money you go, then, the theta is going to look a little better. So one trick that I like to use, if I'm swinging something, like meaning I'm holding it overnight, I'm going to make sure that my delta is at least a 0.3. If it's below a 0.3 and I'm swinging, then it's going to be too close for me to my theta. You don't want to fall into a situation where your delta is lower than your theta, or your delta and theta are the same, because then you're going to need a big move to make your money back. And you don't want to lose money faster than you can actually make it back. So next is gamma. I think of gamma as the gas. So think of gamma as the gas. Gamma is the rate of change of your delta. The cool thing about gamma is that it actually increases with your theta. So you do see traders, including I'm guilty of this, but you see people do like weekly expiration dates and same day expirations. That is not something you want to start off doing, right? Buying time, which you do have to pay a little more premium, but buying time will benefit you in this market especially. So don't feel like you have to buy the weeklies because they're cheaper, because what happens is if you sell early, you get that back, right? You don't have to ride it out just because you bought all the time on it. Excuse me. Vega is going to tell us again how volatility is going to impact our premium. If you understand volatility, then you don't really need to calculate this. But again, just remember that balloon reference. If volatility is high, then just, be mindful that you're overpaying for that premium for the time being. And then row is going to be the effect of the federal interest rates on your options premium. And we will see that soon. We'll absolutely see that soon. All right, so this is the Greeks again, which we just went over these. All right, so here's our terminology: buying to open. We're just opening a new position. This is, again, you always want to make sure that you're looking to make sure you're buying the right thing. I've seen people all the time, they're like, oh, I bought the wrong strike, or I meant to get a put. And you want to double check this before you buy anything. The market is all about diligence, and the market doesn't care about your mistakes or your feelings. So you really want to make sure that you're, super sharp in your execution. So edit the number of contracts you want to buy. So one contract controls 100 shares. Of course, you can buy multiple. The limit price, this is what you want to pay to get in. Again, there's your bid and ask. So that spread looks good to me. So we can go in towards the ask if we want to, or we can just try it at the mid. A lot of times what you'll see, if stocks are moving fast, so are these limit prices. So it doesn't hurt to go in a little bit towards the ask just to help with that. Because if your stock moves really fast, these numbers can jump around on you. And then your max cost, this is just going to tell us the cost to enter the trade. And again, make sure it looks good. If everything does, then you can go ahead and enter that trade. And the terminology, again, to open a position, it's buying to open. All right, so this is Neo. This is a selling to close. So you buy yourself in, you sell your way out, right? So selling to close. Again, this is a Neo call. And this is, okay, so this is another example. There's 4 contracts here. You don't have to sell everything at once. You can scale in and out of these. But in this case, I had 4, I'm selling 1, right? So your limit price, again, there's your bid ask. This time, since we're trying to get out, we want our offer to be attractive to the bidders. So we want to bid, or we want to put in a limit towards that bid. It doesn't have to be the 440, because again, sometimes these spreads will be wider, but it at least needs to be like the mid or closer to the bid to get you out of there. And then again, there's your total exit cost. And then again, if everything looks good, you can go ahead and close the order out. And then also there's a little setting gear. And again, this is Robinhood, so it may be laid out differently, but you can set stop limits, and we'll talk about those too. All right, so a stop price, this is basically going to enter an order for you, and it's going to stop you out once your limit hits that order, like your premium, it's going to hit that number, and it'll actually stop you out of the trade. So these are really cool because if you work, if you have kids or you're in school and you can't watch everything that's going on, you can protect your downside. So like, let's say the stock reverses on you. And this is just very, very basic. We're going to talk about other types of stops. But in this case, on Robinhood, it will trigger a stop and you can actually protect your downside. I don't know why people don't like to use stops. It's kind of like insurance. You don't need it until you need it, right? So it's always nice to get stopped out instead of taking a loss to your portfolio. And then also you can select good till canceled, and that'll actually leave the order there for you. I think it's 90 days on Robinhood, and it won't, if it doesn't trigger the stop that day, it'll just carry over into the next trading day. Let's see. All right, so here's your limit orders, or here's your order types. So you have market orders and you have limit orders. A market order is basically guaranteed to execute, but you're not guaranteeing the price, right? So you're guaranteed to get out of there, but it doesn't tell you at what price you're going to get out, which is another reason that having a nice bid ask spread is important. Because if you slap a market order on something and the spread is really wide, there's a wide range of things that can happen to your order, right? You can overpay, you can actually get out and like lose a lot of profit. So it's really cool that you can have, limit orders. But with the limit order, it's not guaranteed to execute, right? So you set the price that you want to get in or out at, but you don't actually get a guaranteed execution. So there are times where your limit order doesn't actually execute. So that's something you want to monitor. A stop limit order is going to be basically what we looked at with a stop order. However, you can set the price where you want to get stopped at. Now, your stop limit, again, not guaranteed to execute, but if it does execute, it does guarantee you that price. A stop order, that's a market order essentially. So what happens is you can place the order and it will stop you out, just not at a guaranteed price. And then you also have trailing stops and trailing limit. So just remember the market and limit. But your trailing stop, again, a trailing stop is actually cool. It'll follow the trend, and then you can set the percentage or the amount that you're willing to let it reverse on you before it stops you out. So those are really cool. And then a trailing limit, again, it's the same thing. It's just the limit order. So it's going to follow your trend. And then as you reverse so much, it'll actually knock you out of the trade. So these are pretty cool. Probably my favorite type of stop order, honestly, is the trailing stop. All right, so once you're in a position, these are the parts that you're going to see. You'll see your total number of contracts, your total equity. There's your break-even price. Again, that just means you're at 100% profit. This is my limit up here. So how much is totally, or how much each contract is worth. Your expiration date, your current price, and your average cost. So you might hear people say like averaging up or down or dollar cost averaging. Basically, if I buy something, like let's say I bought this, or I did buy this at $393. If I wanted to add one more contract, right now the price is $445. So that's going to bring up my average cost. But that's all this means. So there are times, I'm not a huge fan of averaging down on contracts. Shares are one thing, but contracts, I feel like a lot of times when people take a hit in the market, I think it's better to cut the loss, especially if it's something short term, than to add in more capital into a losing position. So that's going to be something that you want to do with your own discretion. But I'm a scalper at heart, so if I'm in a losing position, I just want to cut it. I don't want to keep adding money to something that's not working out. And I think that's a good practice. Now, shares, if you have a strong company that's getting beat up, by all means, add on and dollar cost average by all means. So then there's my ROI, there's my return on investment. We really like to focus on percentages. Focusing on dollar amounts will really not work it's cool to see the dollar amount, but when you're trading, you really want to focus on percentages. If you can turn $1 into $2, that's 100%. If you can turn $1 into $1.50, doesn't matter, you're just growing your money. That's all we care about, is growing your money. And then down here, there's your stats, and then there's your exercise. There's your exercise button. All right, so there's 4 trading styles. You have scalpers, day traders, swing traders, and position traders. The scalpers, those are my people. Scalping is a fast-paced trading style. It involves buying a large amount of shares or options and selling them after seconds or minutes for a profit. Your day traders, this is just buying a stock or option on the same trading day. Day trades can be performed 3 times within a 5-day trading period, unless you have a $25,000 account, in which then the SEC, it has faith in you that you can day trade all you want, right? Once you hit 25K, you get unlimited day trades. There's also a caveat to that. Some brokerages do let you have a cash account, and you can trade funds that haven't been in the market. So let's say you have an account on like Thinkorswim or E-Trade, like a cash account. If you have buying power, let's say you invest something or you make a trade and you take your money out, you can still continue to trade the money that hasn't been in the market. So you can trade it until all of it has been traded, right? So once it's in and out, it has to settle. So swing trading involves buying a stock or option and selling it at a later date. This can be done short or long term. Swing trading can be like, I'm buying it today, selling it tomorrow. It can be, I'm buying it today, I'm selling it in December. It can be, I'm buying it today. It doesn't matter, just holding it overnight. And then your position traders, position trading involves buying a stock or option and holding it for a long period of time. And then this can range from several years to months. I know we were looking at Gush Leaps last year. This is actually interesting. We found Gush Leaps, the $85 Gush calls for 2023. They were $135. Last I checked, they were almost $7,000 a piece. They may be there now, but that's just the power of options, right? And that's literally buying a leap and holding it. It went from $135 to almost $7,000, which is insane. Okay, so let's see. We can get into some TA. This is just going to be some basic TA, and then in the next session, we'll get into our fundamentals. So just remember, there's two ways that we can analyze stocks, right? So you have the fundamentals, which is like the books, making sure people in charge know what's going on, making sure the company is strong and profitable. And then you have the technical side, the technical analysis. So this is just going to be purely charting. So I think it's important to remember too, with your trading styles, I tell my students it's kind of like a spectrum, right? So you have your scalpers, your day traders, then you have your swing traders and your long-term people. So think of it as a spectrum, right? So on the short side, like on the scalping side, we have technical analysis that's really, really important. And then on my long-term side, I have the fundamental analysis that's really, really important. So the longer you plan on being there in a trade or in an investment, the more you need to dig into the company. But you do need all of them. But like for me, scalping, I might just need a headline. For someone who's long-term, you definitely want to dig into that balance sheet, which we'll talk about that. But now we'll do technicals. So these are your charting platforms that I personally like. I'm really big on Thinkorswim and TradingView. TradingView is probably my favorite. But you create an account on any of these platforms and get started. This is something that, to me, charting is everything. Charts tell the story. So I definitely recommend finding a charting platform that you personally like and understand, get to know it outside of the market, and practice. I can't get enough of my charts. All right, so these are just some common indicators. The RSI, Relative Strength Index, that's gonna let us know if a stock is overbought or oversold. If the RSI is over 70, it indicates that a stock is overbought, and it will likely sell off, causing a dip in the share price. Again, just because the RSI is 70 doesn't mean the stock is coming down, especially with this volatility we've been seeing. Your stocks can actually rip above 70. So I'm really big on candlesticks and candle formations and volume, things like that. But 70 is typically the number to watch for. On the flip side, in this example, the RSI came up to 80, which you can see where it topped out here. And then here's our dip, right? The RSI came down, and there's the actual number there, 80.02. So here we're overbought. And then there we start to saw that little pullback there. It wasn't a huge pullback, but it was a bit of a dip there. So if you're someone who wants to buy puts and profit as the price goes down, the RSI over 70 is a good signal to start watching for entry on puts. All right, so an RSI below 30, which in this case, the RSI got down to 27. So when the RSI is below 30, that's basically telling you that the stock is oversold. And it's a buy signal. Again, this can be a good entry point for buying calls, and a sell signal for buying puts. However, remember, again, it can go well below 30. I've seen the RSI on the SPY get down to like 6. So just because it hits 30 does not mean to just slap, buy on a put or buy on a call, because it can absolutely keep falling. You definitely want to look to other confirmations. RSI, it's a lagging indicator, so it's not going to update in real time. But if you see these wild swings in the market, it's just one way to kind of gauge, but you don't want to base anything purely off the RSI, because it can be very misleading if it's used just by itself. All right, so MACD, moving average convergence divergence. This is a momentum indicator. It basically just tells you who's in control of the price, right? The buyers or the sellers. So you see down here, this is the MACD. You have these two lines. This red line, this is your signal line. And then this blue line here, this is your moving average line. And so how this is read, you can see you see these thick green bars, that's strong buying. Where it fades out, that's weakness. Over here, there's some strong selling. And then where it kind of fades out, that's weakness. So when the MACD crosses up over that red signal, that's a buy signal. Again, you want to look to your candles for confirmation, but that MACD cross to the upside, that's a buy signal. Another thing to watch for is the relationship between these two lines, right? So if the MACD crosses, but the lines kind of hug each other, you don't have any momentum, right? So look at these lines, they're kind of hugging each other. So these are not buy and sell signals. They're literally intertwined. For your movement, right? For your big momentum, your movement, these lines have to move apart. And then you see here, there's an uptrend and the MACD lines actually did move apart. So just like this is your buy signal, this is your sell. So there's your sell signal. When the blue line crosses down below that signal, that's a sell signal. All right, and this is just another example, but this is some more like there's a buy signal, there's a sell signal, so on and so forth. One thing to remember too on your chart is depending on the time frame you're looking at, your MACD and RSI are going to be completely different. So if you're planning a trade, you want to make sure you're on the right time frame for whatever expiration you have, right? So if you have something that expires in 2023, then you do not want to be basing that on a 1 minute chart, right? Because that one day, 1 minute has no bearing on your full on leap for, a year from now. So make sure that you're looking at the right time frame. The trend is your friend until the bend at the end. I think that's so cute. But just remember, whatever trend you're trying to capture, make sure you're looking at the right time frame so you can make sure you're making the right decisions on your options. All right, so we're going to talk about support and resistance. So support is the floor. Once your stocks approach support levels, they're either going to bounce, which means they're going to hit a certain point and go the other way, or they'll break support and continue into a downtrend, which we saw a lot of support broken yesterday. So these price levels are really important to watch. Resistance, just like support is the floor, resistance is the ceiling. So this is where your stock's going to rise until they reject and come back down. So it's important, and you'll see again, depending on your time frames, you're going to see your stocks, they're going to revisit these levels. They're going to revisit price levels. So it's super important to be aware, because what happens is your stocks will behave differently as they approach these levels. Like Tesla, for example, and I'll show you guys a chart too, but Tesla yesterday, it banged its head on 826 over and over and over. And then once it broke that support, it was off to the races. I think we hit 794 after hours. I don't know where we are right now, but you can see once we break those levels, people will either, funnel in to start buying if we're breaking resistance, or, they'll start dumping if we're breaking support. Let's see. All right, so we have moving averages. There's two different types that I like. The simple moving average is, okay, yeah, so the simple moving average is the white one. No, it's not, it's the red one, sorry, it's cut off on my screen. So the simple moving average, this is gonna smooth out our price action over a number of days. So this is just how our prices moved over the last, in this example, it's 9 days. The thing I like about the simple moving average is that it's gonna give equal weight to each value, right? So every day it's gonna smooth that out for us. So on the flip side, the exponential moving average, it's still a moving average. It's still gonna smooth out that price action, but it's gonna put more emphasis on the most recent price action. So for my short-term traders, EMA is your best friend. For my long-term people, you definitely wanna use a simple. And I like both of them, don't get me wrong, I like them both. But for me as a scalper, short term, I need the EMA because it's going to update a lot faster. The simple is perfect too, though. When you're doing long term, you definitely want to make sure that you're using a simple, because if you're trading heavy volume, a couple pennies here and there, that actually can add up on heavy volume. So the simple is better for the long term people. All right, so volume is another indicator that's super important. It shows you the number of shares traded throughout the period. Each candle is going to have its own volume. Depending on your time frame, you'll have different volume for that. But for me personally, as a momentum trader, I need volume. The days where the market overall has low volume, it's a snooze fest. I need movement. So again, you can look at overall volume for the day. You can look at average volume. Looking at average volume is a cool way to kind of gauge and see if it's a low volume day. Like I like trading SPY, but I know if the volume's low, then it's going to act a little wonky. So yeah, that's just one thing to keep in mind. Volume is a huge, huge indicator. And as well, when you're in a trade, it's cool to make sure that there's volume that's still coming in, whether it's buyers or sellers, depending on what side you're on. All right. All right, we'll do one more slide and then we'll take our break because I didn't realize it was 10:49. All right, so this is just anatomy of a candle. So you have the body, right? There's the body of your candle. The wick or shadow that tells you like your intraday high and low. Again, depending on your time frame, you know, it might be like a 5-minute candle. That's just going to tell you what happened within that 5 minutes, so on and so forth. So one thing to notice on your buying candles, your high, your close. Yeah, I just like to monitor volume. I just like to monitor volume. But yeah, that was a good question. So then you open and then there's your low, no problem. On the flip side, here's your sell candles, right? So there's your high, your open, your close, and your low. So they're a little bit different, but nonetheless, I love candles. Like you guys will see this in the next segment, but I absolutely love the candles. So yeah, and I think I want to reword this because honestly, every green candle is not necessarily bullish and every red candle is not necessarily bearish. If you're using Heikin-Ashi, I definitely think we should reword that. But candlesticks, they do form different patterns. I prefer the Heikin-Ashis. I don't know if I said that. But it's really important to be able to recognize the patterns because they can really, really help you in your trading. They can really help you kind of avoid things. They can help you take advantage of things. And so we'll get into some more of that in just a bit. But if you guys are ready, we can take a break. Hey, David, are you there? Oh, I don't know. We can keep going. Do you guys want to keep going? I don't know. I don't know if he's there. Okay, I'll keep rolling. That's fine. Okay, let's get into some of these formations. So the head and shoulders, this is a cool pattern. It's literally a head and two shoulders. And this is going to go for your price level. So basically all this is, it's going to be one level of resistance, which your two shoulders are going to tap. They're going to bang their head. And then you're also going to have a head. And your head is going to be a second level of resistance, a little bit higher. So one thing to remember in the live market, these things are not going to be perfect. Sometimes they will be, but the key is to identify those price levels. And so with your head and shoulder, this is a bullish to bearish reversal, meaning you have what's called a neckline. You see, we have a support level here where we tap. And so once we break through that neckline, this is where we would find our entry, right? This is where we want to enter our puts on our downside. And this is also where we want to enter our stop loss, right? This is where we want to enter our stop loss. Another thing to remember with your candlestick patterns, make sure you let the pattern fully form before you trade it as a pattern. I've seen people let like one shoulder and one head get formed and then they enter, but like this isn't, it's not all the way there, right? You can't just imagine the rest because we don't know what's coming. So make sure you let your pattern fully form before you take your trades on that. But that's your head and shoulders. And there's also an inverse. I think that's on here though. All right, so here's a double top. Double top, think about McDonald's, the big golden arches. It's just gonna make an M, right? An M shape. So you're gonna have a level of resistance. Excuse me. You're gonna reject that level of resistance twice. Again, you have a neckline. Double tops are bearish. Once you break that neckline, you find your entry here, and then there's your entry on your puts, and you ride down that bearish reversal pattern. Again, wait until you form or break the neckline because it can very well bounce off support and become something totally different. So you want to make sure it's fully there. All right, so double bottom is just the inverse of the double top. So the double bottom, again, you have two levels of, you have one level of support. You're going to drop down to that level twice. Your neckline, it's just the opposite. So here across the neckline, you'd find your entry on a call. And then you would ride your profit up, ride out that reversal. So another thing again here, this is where you'd enter that stop right at your neckline. All right, so you have a rounding bottom. These are pretty cool. It just looks like a big U, but it's kind of like a fake out. So it's like you kind of dip, but then it rounds out, and then it's a continuation. So if you see a rounding bottom, there's also rounding tops. But it's just a continuation pattern. So if you see your price action kind of round out like this, you can go ahead and lock it, or you can go ahead and ride out that movement. One thing I will say to my short-term people, this isn't something you want to ride out, right? If you're scalping or day trading and you see this rounding bottom form, for all you're going to see at first is this, right? This drop. So if you see the drop coming, go ahead and lock in your profit on a short-term play. And then if it comes back out and rounds out, then you can re-enter and ride out the continuation. But I really want to encourage my short-term people not to just get comfortable riding out reversals, because everything that drops is not going to round out like that. All right, so your cup and handle. This is a bullish continuation pattern as well. And there's also an inverse to this, which just means the opposite. But your cup and handle, again, it's going to be a rounding bottom with a bull flag. So once it rounds out, it's going to form this bull flag. And then again here, you want to form, or you want to find your entry after you break out of that upper trend line on the bull flag. And again, this is where your stop is going to go, right? Your stop's going to go here, and then you ride out that continuation. And same thing, right? If you're short term, you do not want to get comfortable riding out this, because again, we don't know that it's going to round out, but once we see that and we can confirm it, then we can jump back in the position. All right, so rising wedge. This is typically going to signal a decline. The biggest thing to watch here is the trend line. So you can see there's a lower trend line here, and there's also an upper trend line. But for the rising wedge, right, because this is an uptrend, once all you're looking for with this is breaking out of that lower trend line. Again, there's your put entry, and then there's where you want to put your stop. And the falling wedge is just the opposite, right? So there's our lower trend line, there's our upper trend line. This is a downtrend. Once we break out of that upper trend line, this is where we want to enter, put our stop, and then we can ride out the breakout of that rising wedge. All right, so flags and pennants. These are gonna come, I've seen a lot of these. I actually saw one on Tesla Friday, but these can be bullish continuations. So one thing I will say that's really important is to use trend lines. Just use trend lines, because there's a lot of different formations. There's a lot of names for them. And so really what you want to do is identify the actual trend line and then just trade off the trend line. So you don't have to get bogged down with I don't know what this is called. You can still trade something without knowing the name of the actual pattern. So if I look at this, if you don't know what it is, literally just there's your trend line, there's your entry point, and we're breaking out of it, right? So it can be very, very easy. You don't want to overcomplicate the market, because it can be really fun. You just don't want to overcomplicate it. All right, ascending triangle. So in this case, you're gonna have a level of resistance, and you see how the stock kind of banged its head there a couple times. But if you notice, look at your support level. Support level is rising. So anytime your support is rising, that's good, right? That's good for the bulls. And so here we broke out of that upper trend line, and there's your breakout, and you can also get in a position there and ride that trend up. Or if you're in something, right? Let's say you're already in this, and it starts to form this pattern, then you can just hold on to it and wait on your breakout. All right, so a descending triangle, this is going to give us lower highs. This is a bearish continuation. Let's say we're already in that downtrend. Again, look at our resistance level. Anytime your resistance is dropping, right? Resistance levels are dropping, that's bearish. So yeah, we break support. Once you break out of that support, then you're off to the races and you can ride that down on your puts. And that honestly kind of looks, I don't know. It kind of looks like a rounding bottom, but it's just a weird picture. All right, and then these are just some individual candlestick patterns. But again, the biggest thing to know is the body is important. The wicks are important. Like look where your highs and lows are. That's really the biggest thing. But there's a lot of these to kind of learn. But yeah, that's all for the TA part. And before we pull up the live charts, but I do want to do fundamentals with you guys. David, are you there?
Yeah, I'm here.
Is it okay if we take a quick break?
Yeah.
Okay, good deal.
All right. I'm gonna stop the recording.